So market efficiency. So some more theory now and then sums will begin. Okay. So market efficiency, informationally efficient capital is one in which the current price of a security fully, quickly and rationally reflects all available information. So informationally efficient capital market. Okay. So that means capital is moving based on the information, complete information. So it is all rational decisions that they are taking. Then active investments and active and passive investments. Passive means you are trying to copy the market and you are going as per the index and investing. Active means you are trying to beat the index. Okay, how will you beat the index? You will change the weight, you will change the securities, and you will try to get more returns than the index. Then the market value of an asset is okay, or is its current price. Then intrinsic value or fundamental value of an asset is the value that a rational investor with full knowledge about the asset's characteristics would willingly pay. That is the intrinsic value. That means, say for example, the intrinsic value is 50 rupees, but in the market it is valued for 55 rupees. So there can always be differences. Okay, because it might be overvalued, bull run is going on. Same way, undervalued, bear run is going on. All those are possible. Then these all are not required as such. This one is very important one, but again you can learn this better only in the website questions, not here like this. But shortly I'll tell you. Like it says weak form market efficiency. So efficient market hypothesis. The heading will be efficient market hypothesis, EMH. Efficient market hypothesis. So weak form. Weak form market efficiency. Weak form market efficiency means what? Here, everybody knows the historical data. So one cannot make abnormal profit. So here everybody knows the historical information. Historical information. So nobody can make abnormal profit. Nobody can make abnormal profit. However, if you are trying to use historical data, okay, so historical information means what? Technical analysis. So however, so therefore, if you are using technical analysis, if you are using technical analysis, this weak form market is inefficient for you. Can you understand this term now? It is not efficient, it is inefficient. That is why you are trying to use technical analysis, because otherwise one cannot make abnormal profit. No? Everybody knows historical information, so nobody can make abnormal profit. But you don't believe in this theory. So that means for you, how is the market? Market is inefficient for you. That is why you are trying to make more profit by using technical analysis.
Okay.
Fine. Similarly, now semi-strong. So semi-strong form market efficiency means what? Everybody knows technical analysis Everybody knows technical analysis and fundamental analysis. Okay, everybody knows technical analysis and fundamental analysis. So nobody can make abnormal profit. Nobody can make abnormal profit using technical analysis and fundamental analysis. Now, suppose if you are trying to use fundamental analysis here, so that means for you it is semi-strong form market inefficient. Okay, so therefore if you are using fundamental analysis, it is semi-strong form market inefficient. Inefficient. Is it okay?
Yes, sir.
In weak form market, you can still use fundamental analysis to make abnormal profit. If you are in semi-strong form, that means you are considering as inefficient this word. Then strong form market efficiency, the question will be basically between these two only, because in strong form it's very clear that nobody can make abnormal profit. Okay. Strong form efficiency, strong form market efficiency. Everybody knows technical analysis, fundamental analysis, and even inside information. That is private information. So nobody can make abnormal profit. In strong form, market efficiency. Okay, is this fine?
Yes, sir.
Rest is, based on the question only, they will twist with words, and then accordingly you have to figure out the answer.
Okay.
Then all this you can ignore. And this term you should know. Data snooping or data mining. That means basically you are investigating data until a statistically significant relation is found. That means you are finding data in all different angle, and then you will use it the way you want it. Okay, so for example, you can find data sales from yearly perspective sales, monthly perspective sales, weekly perspective sales, then daily perspective sales, weekend perspective sales, morning perspective sales, evening perspective sales. So it will give you different report, right? Quite possible that maybe Tuesday, Wednesday, Monday, Tuesday, Wednesday, people might not be doing shopping, and then
Yeah.
Saturday, Sunday, people will do more shopping. So so if you see weekend data, there will be more shopping. If you see weekdays data, there will be less shopping. So data can be mined in all different angle. It is data mining.
Okay. Understood.
Then anomalies. Anomalies means something deviating from the normal behavior. So market is supposed to change because of the fundamental. But here the market movement is happening for some other anomalies. Okay, so here anomaly, so something deviating for some other reasons. So what is it? Like tax loss selling. So that means over there in US they follow Jan to December financial year. So December ending, market tends to fall over there because whoever is in unrealized loss, they tend to sell and make it realized. Why so? So that they can file tax, as they have got losses. And then in January they will again come back. They will again invest. Okay. So because of this reason, then uh, window dressing means it is basically manipulation of the balance sheet and income statement. You will over exaggerate the data. That is window dressing. So because of all these reasons, the uh, market or the stock may not be having its original form, may not be in its original form. It may be in anomaly then. Then December ending, normally market tends to fall down because again investors pull out money to celebrate Christmas vacation. So all this happens. Then momentum anomaly. Some stocks will be in momentum. Okay, momentum means what? It will keep going up and up because maybe there can be some tailwind. Momentum may be going up or maybe going down also. It will have some tailwind. Tailwind means what? Let's say government is framing some rules to support it. Say for example renewable energy. Then it will become this will come into momentum that will keep on going up. Those are all momentum effect. Okay. Then value stocks and growth stocks. Value stocks are those with lower price to earning ratio. The price is low comparatively, okay, and lower market to book value. So all these are these two are characteristics of value stocks. Growth stocks means whose P ratio is higher or market to book value is higher and lower dividend yields. Because they are growing very fast, the price market will value them higher, but the dividend will be lower because they need money for further growth. So they will not pay high dividends.
Okay.
And these all not required, the basic stuff. Behavioral finance is, wherever you see behavioral finance, it is an important one. So you read it. Okay. It's not difficult, but still important one. Now here, loss aversion, investor overconfidence, and herding mentality. Loss aversion means that is a hypocritical nature of an investor, that we are okay with profit, but we are not okay with loss. Okay. So that is a hypocritical nature. So we tend to overreact in losses than in gains. Okay, so that is our risk averse in behavior. Okay, that is called loss aversion. Then herding mentality. Herding means just because everybody is doing, you will also follow that one. That is called herding mentality. Everybody is buying, let's say everybody is buying Reliance, you are also buying Reliance. That is herding mentality. Okay. Information cascade means information spreading out. So this is all normal only. Then overview of equities, statutory voting and cumulative voting. Statutory voting means one vote, and say for example, two auditors are being appointed. Okay, so if two auditors are being appointed, one and A and B. So statutory vote means, let's say, one vote for one share. So if you have two shares, or imagine if you have only one share. So if you have one share, you can vote over here also, and you can vote over here for each decision. This is one decision, this is one decision. This is auditor A or auditor or director, anybody, okay? So you are voting here and you are voting here, one vote you are casting. That is statutory voting. Cumulative voting means you may say, like, I don't like B, I don't want to vote for B. Now, because there are two people, I have two votings. Cumulatively, you have two votings. Now, that two votings, you can cast it for A. That is cumulative. So cumulatively, you have two vote, and both you will cast it for A, and you will not cast any vote for B.
Okay.
Then it is called cumulative voting. Okay. So this way you can have better say towards the decision that you want, and the decision that you are not interested in, you can leave that one. Then preferred stock, cumulative stock, all this thing.
Yes, sir.
I think we discussed, this one last time. No?
Yes.
Yeah.
We did.
Then private equity and venture capital. So venture capital, they invest in the in a company which are at the early stage of their life. Okay, early stage of their life, and here also it can be segregated into different parts: seed or startup venture capital, early stage, or mezzanine financing. This also you should know, theoretically you should know. Private equity means it's a well established grown up company, but they just need money to expand. that is private equity. Okay, privately they are buying shares of another company. That's why private equity. And venture capital is at the nascent stage. Okay, so this is the order. Seed stage. Seed stage means at the stage of idea. Seed stage, uh, early stage, and then mezzanine financing stage. Then in your leveraged buyout, and yeah, what is leveraged buyout? Leveraged buyout is uh, you are borrowing to buy a company. That is leveraged buyout. Okay, using debt financing, you are buying a company. Okay, then uh, managed buyout means what? Where if the buyers are the firm's current management, then it becomes management buyout. Like you see that Bharat Pay, the management only took over, right? Ashnir Grover was the founder, so he has been shown the door. Okay, and the management took over, so that is management buyout. Okay, then pipe in India we say something like PPP, right? Public private partnership. Example, now metros are there. Now metro, you must have seen like Reliance. Let's say Reliance is building metro. Now they're building metro, but metro, where is it? It is with in public's place, right? Or public property. So it is a public private partnership.
Okay.
Okay.
Yeah.
Similarly, here they say pipe. Pipe is in private investment in public equity. So a public firm needs capital quickly. The public firm that needs capital quickly sells private equity to investors. A public firm that needs capital quickly sells private equity to investors. So private equity to investors and done by a public firm. Okay. Then depository receipts. So depository receipts means what? Now depository receipts as in so ADR means what? ADR is being in America, you are owning non-American company shares. This is India. And this is US. So uh, so these investors who are interested in Indian company shares, let's say Infosys. So normally they will do international trade, and that might be more cumbersome for them because of different currencies, different time, international rules, and all those things. So JP Morgan will buy Infosys, bring it to India, and then they will club multiple shares together. Okay, so that currency perspective, total amount perspective, it is at par with US market. Say for example, if one Infosys is 90 rupees. So if they bring it to India, then it will become $1, and that $1 might look like a penny stock. So they will club 10 Infosys together. So that means 900 will be equal to $10. So like this, they will sell it in the market. Okay, now this ADR, American, this is called ADR, American Depository Receipts. And this JP Morgan is called as Depository Bank. depository bank. Okay. Yeah. So American depository receipts are of three types. One is unsponsored. That is called level 1, then level 2, then level 3. So this level 1 is unsponsored. Unsponsored means it is happening through over the counter. So they are directly selling it to the investors, no stock exchange, so not listed. Okay. Then second one is sponsored. Third is also sponsored. Okay. So sponsored, this is what does this mean? Now Infosys in the second one, Infosys, because there are many investors there, they might decide to list their shares. So it is listed. Okay. Third one is they are raising capital and listing. So raising capital and listing. Okay. So this is the table here. The last one is not needed as such. 144A means you can sell it to the investors without registering with SEC. Okay. Here, privately placed. That is rule 144A. Privately means without registering with SEC, you are privately selling it. Okay, you can see 1, 2, 3 column.
Yeah.
Then this is one example. Depository receipts, exchange traded. That means in this exchange traded fund will invest only in depository receipts. Then return on equity, you should know all these formulas. Returns as in net income divided by equity means average equity. Okay. So when you get this kind of formulas, normally see for balance sheet transactions, it will be coming as average. Okay. So if this would have been return on assets, then that will be net income divided by average assets. Okay. Or imagine inventory turnover ratio. So it will be cost of goods sold divided by average inventory. So because inventory is what from the balance sheet. Whatever is coming from balance sheet, generally you tend to take average there. Okay. So equity is coming from balance sheet, right? So average. So this sum is very straightforward only.
Yeah.
Simple sum. This is also self-reading only, but interesting one, but self-reading one only. Business models. So its operations is based on its products and services, customers, sales channels, pricing and payment terms, and suppliers. Okay.
So depository receipt is when the foreign company's stocks are available on domestic exchange.
Yeah.
Okay. Yeah.
But domestic means, what do you mean by domestic? Say, for example, now if I say Infosys shares are available, in US. Now for you, domestic is what? Domestic is India. Okay. Now your definition is not fitting in. What you have read is from US perspective. If you are an US citizen, then it makes sense.
Okay.
So you can say that's why foreign company shares are being or shares of uh, what did I say? Non-American company shares being traded in America. That
Okay.
is ADR. That way, if you say that is ADR.
Okay.
Then revenue drivers, pricing power, all these are self-explanatory only. Okay. Business is going because of revenue, because of its pricing. Then these are all very common things. Yeah. This one, okay. So this one, the formula is, this is called leverage. Okay, it's called leverages. So operating leverage, financial leverages are there. So here the formula is revenue or sales minus cost of goods sold will give you contribution. Uh, then minus contributions minus, no, sorry. This will be revenue minus variable cost. Will give you contribution minus fixed cost will give you EBIT. This format is called behavioral classification. Behavioral. The one that we normally do, that is functional classification. Behavioral classification of expenses. Okay. Functional one is the one that we normally do. That is sales minus cost of goods sold. Then gross profit minus SGA. Then EBITDA minus depreciation. Then EBIT. So now we'll see only till here. After that, there are further steps also. So here, say for example, 1000, variable cost is 50, 500, let's say contribution is 500. This contribution is not the profit now. This contribution is contributing towards fixed cost now, to cover fixed cost. So let's say fixed cost is 250, EBIT is 250 then. Now, let's say if this sales is increasing by 10%, it will become 1100. So similarly, variable cost is proportional to sales. So this will also increase by 10%. So that will be 550. So here 550 is the contribution, but fixed cost will remain fixed only. So your profit is increasing now. Okay, so this comes to how much? This comes to 50 divided by 250 into 100. So just calculate. I think it is 20%. Yeah, 20% to
Yes.
20. So that means profit, sales went up only by 10%, but profit went up by 20%. This is leverage power.
Okay.
Okay. Similarly, so here the formula is degree of operating leverage. Degree of operating leverage is equal to percentage change in EBIT based on percentage change in EBIT percentage change in EBIT based on percentage change in sales. Okay. Then, so this is the formula, or there is one more formula. So what is that formula? One more formula is EBIT by contribution. Contribution by EBIT. Contribution by EBIT. So that is 500 divided by 250. That is equal to 2. This is also equal to 2. Is it okay? So this is for base case scenario. Base case means, suppose if this is not given here, this part. Okay, only the first part is given. Then my degree of operating leverage is contribution divided by EBIT. Then further, have you understood this one?
Yes, sir.
So further, if I write minus interest is, imagine 50 rupees. Then earning before tax is 200. Then minus tax 30 rupees, let's say 30% tax, that comes to 60. 140. This is the net income. Okay. So here, degree of financial leverage. Degree of financial leverage. Financial leverage means basically operating leverage, your profit is going up because of the fixed cost. In financial leverage, your profit is going up because of the fixed financing expenses, that is interest. So here the from formula is percentage change in uh, uh, this is earning after tax. Okay, so percentage change in earning after tax, you can say net income also, anything. Percentage change in earning after tax or net income based on percentage change in EBIT. Okay, so here 300 was the profit. Interest will be same 50, so this will become 250. Take 30% of 250.
75.
250 minus 75.
175.
So yeah, now what is this change now? This will be 30 divided by 140, 35, right? 35 divided by 140 into 100.
25%.
So 25 percentage divided by EBIT will be percentage change in EBIT. Percentage change in EBIT is 20 percentage now here. Just calculate this. 25 by 20.
1.25.
So this is the degree of financial leverage. I can even write it in another form. For base case, it will be EBIT divided by EBT, earning before tax. So EBIT is 250, EBT is 200. Now check this one. 250 divided by 200.
1.25.
Yeah. So this is base case scenario where you are going to use only this number in base case. If the next year is also given, then you will use this formula, percentage change.
Okay.
Okay. Then okay. Yeah, so this is also done. Then next is degree of total leverage. Degree of total leverage is degree of operating leverage into degree of financing leverage. Degree of operating leverage is what? Degree of operating leverage is 2, right? So 2 into 1.25. Just calculate it.
2.5.
So, or there are multiple formulas. You can even say total change, right? So what is the total change in the profit based on the change in sales, percentage change in sales? So percentage change in earning after tax based on percentage change in sales. So this will be percentage change in earning after tax is 25% divided by sales. So that comes to 2.5, right? Which is what we got here. Okay. Then another formula is, you can take the base case degree of operating leverage. Base case was contribution by EBIT into degree of financial leverage is base case is EBIT by EBT. So this gets cancelled. So left is contribution by EBT. So contribution $500 divided by EBT 200. So just check this one. This will also be 2.5, correct? Okay. Hello, is it fine? Hello?
Yes, sir. 2.5.
Yeah. Okay, so clear, fine with this one. This formulas you have to remember. Multiple formulas are there, all you have to know, because you never know how they are going to ask. Okay. And this formula is also the same thing only. You see, quantity, see, this is price minus variable cost. Now this is contribution into quantity will give you into quantity, or if you expand this, okay, this is just common sense formula only. See, this is Q into price minus variable cost. Price minus variable cost is minus fixed cost. So now if you elaborate this, quantity into price minus quantity into variable cost minus fixed cost, then it will become what we did, revenue or sales minus, what is this? This is variable cost, total variable cost. This is total sales, total variable cost, and this is total fixed cost. Total fixed cost. So this will be contribution. Okay, this part is contribution. Okay, so When you solve this, you will get contribution. This is contribution. Contribution minus fixed cost will give you EBIT. EBIT is what? Operating profit, which is mentioned here. Operating profit is EBIT. Is it okay? Fine.
Yes, sir.
Okay. Degree of financial leverage, all those are there. This is earning after tax or net income divided by financial leverage. This is EBIT. Operating income means EBIT. These all are self-explanatory only. Easy, also interesting one. Cyclical defensive company means what? Like pharma and FMCGs are defensive companies, because no matter what, people will demand. Okay, be it recession or not. Cyclical is during bull run it will do well, during off season it will not do well. Okay. Like automobile company. Then ESG is also self-explanatory. Mature industries, growth industry. Growth industry means sunrise industries, which are growing, and mature industry means which are not growing. Okay, like TCS, Wipro, Infosys. These are all just mature industries. Okay. Or even Hindustan Unilever. So at certain rate only it will grow now. Then yeah, this one, do you remember? This is okay. Herfindahl Richest Man Index. So this is when a company is getting merged with another company. So there are, let's say here they have mentioned 5 firm HHI. 5 firm. No, a market is consisting of 5. Okay. So 5 firm. So top 5 companies. So first company is having 35% share in the market. Second one 25%, then 20%, then 10%, then 10%. So what we will do is whatever number they say, like if they say 5 firm, we will take 5 companies, but we will square all those. So 35%, 25%, 20%, 10%, 10%. When we square, it tends to exaggerate the number. That is the reason. It tends to make the number bigger, okay, which we want. So when we exaggerate, it will go to 2450 here. Now, if this number is between, this one you will have to remember, okay. So an industry with an HHI less than 1500 is considered to have low concentration. HHI between 1500 and 2500 is considered moderate concentration, and greater than 2500 indicates very high concentration is there. That means few companies are controlling maximum part of the industry. Like you saw this Indigo fiasco. Now, why Indigo? You must have heard about it, right? The
Yes.
passengers facing problem. Why so? Because it is a monopoly. Okay, it is a monopoly or duopoly. Hardly Air India has 30 percentage and 65 percentage Indigo has. So together they are controlling 95 percentage. And so if one company faces problem, the entire passengers are facing problem then. Okay, that means high concentration is there in such business. Is it okay?
Yes, sir.
This is also something you can read and understand. Porter's, but you should read it. This one is the important one. Porter's five forces. So rivalry among existing. If there is more rivalry, you should not get into that company. Threat of new entry is there, you should not get into that company. Then there are substitutes available, you should not get into that company. Power of bias. That doesn't mean everything, you should not get into. It is just to analyze, because when we analyze, not necessarily that every points will be in green color. Some will be in red also. So you have to see majority is in green or not. So you should be aware about all these things. Okay. Then Pesley analysis. Pesley analysis, again, this is just a short form that stands for uh, P stands for political influences. Where is it? This is E. Uh, Here it is. Political influences. Some companies will have political influences. You have to check all this, whether it is favoring or it is against the government. Social influences. Like iPhone will have social influences. Right? People tend to feel good, or branded clothes. The social influences, technology. Then cost leadership strategy and differentiation strategy and focus strategy. Cost leadership is Reliance. They are selling everything at the lowest price. Okay, so then it becomes cost leadership. Differentiation is iPhone. They are differentiating the product, but the cost is high. Okay. Focus strategy is a combination of both, like say which is in between, like Samsung. Okay, little bit okay brand and at the same time quality, that way. Okay. This page all you can ignore, doesn't matter, this table. Here all these are self-explanatory. If you don't read also, it's fine, but this one you should read. Top down revenue forecast. That means, again, this is more useful from understanding perspective, uh, understanding more conviction. Top down means you are starting from the macro level, GDP, sector, industry, then companies. That way, when you come down to the particular stock, then it is called as top-down revenue forecast or top-down approach. Okay, how much GDP will grow? So on that basis, how much sector will grow? On that basis, how much industry will grow? And then which company further will grow, revenue will grow, that you are predicting. Bottom up means based on the company. Okay, company at what price it is selling, what is the volume. So in bottom up drivers, all this will play a role.
Okay.
Mm. Then this sum, this sum is a good one. You should practice this. They have given some formula also, but you don't have to remember formulas and all those. Just with common sense, you should be able to do this sum. I'll just do this now in front of you. You just go through the question.
Done, sir.
Okay. Okay. So here, uh, cost of goods sold as a percentage of sales equals 25%, and that the quantity sold is the same in period 2 as in period 1. Okay. Here, assume that a company's cost of goods sold as a percentage of sales equals 25%, and that the quantity sold is the same in period 2 as in period 1. Okay. Cost of goods sold as a percentage of sales is 25%. So sales, if it is 100, cost of goods sold is 25. So gross profit will be 75. And that the quantity sold is the same in period 2 also. So you think this is one quantity, then it will be easier. One quantity is 100 rupees. If the cost doubles in period 2, so for this one quantity, now the cost is doubling to 50. Okay. Doubles in period 2, and the company can pass on the entire increase to its customer through 25% price increase. So 25 rupees it has gone up. No? So here also they are increasing 25%. So it will become 125. Understood this step? So now what is
Yes.
the gross profit? Calculate. This will be 75. So it is the same gross profit. And then cost of goods sold as a percentage. The company can pass the entire increase onto its customers through 25% price increase. COGS as a percentage of sales will increase to 40%. So COGS as a percentage of sales here it is 25%. Here it is how much? Take 50 divided by 125 into 100.
40%.
So that's what they have mentioned here. Okay. So now your gross profit, here your gross profit is 75 divided by 100 into 100. So 75%. And here your gross profit will be 75 divided by 125 into 100. Just calculate this.
60%.
Okay, yeah, so this is it. Is it okay?
Yes.
Then this one, should I repeat this on accounts receivable? This is a part of FSA actually. But okay, still
No,
I'll just not needed. You want it or not, this part?
no, sir, it's fine.
Okay. Okay. Yeah, equity valuation concepts and basic tools. So here, these are the 4 methods. I think this I can do then next time, because I think better if I do this all in one stretch, it will be better. Because this is thus now the sums all will begin now, right? From here, sums all. Or if you have time, I can stretch but easily it will take maybe 1 more hour. You have time?
Yes, sir.
It's fine. Shall I continue?
Yes, sir.
Okay. Okay, then I'll finish it up today itself. So here, yeah, so this is again a very important topic, okay? So here, how equities can be priced. So equities can be valued through 4 methods in level 1. Discounted cash flow model. Then second one is multiplier model. Then enterprise value model. And then fourth one is asset-based model. Now, before we get into this one, they have explained some part about some corporate actions like stock splits and reverse stock split, share repurchase. So stock dividend means bonus as in additional shares given to the shareholders freely. Okay, additional. So what happens in bonus? The share price will come down proportionately. Okay, and but then the number of shares will go up. That is stock dividends. So instead of rewarding them with cash, they are rewarding them with shares. But here, that doesn't mean portfolio's value will change. Portfolio's value will remain the same. Price per share will come down. Similar case for stock split also. They are splitting one stock into multiple. So what will happen? Price per share will come down. So both are more or less same. Some differences are there. So one stock is split into multiple parts. Okay, say for example, if it is stock split, so it is split into 10 parts. One stock is split into 10 parts. So if it is 1000 before, now it will be available at 100 rupees because it has been split into 10 parts. So earlier you had one stock worth 1000. Now you will have 10 stocks worth 100 each. So total value will remain the same. That is stock split. Same case for stock dividend also. But then in stock dividend, the face value is not going to change. Whereas in stock split, the face value will also come down proportionately. So if the face value in stock split earlier was 10 rupees, now it will be 1 rupee. Okay, because it has been split into 10 parts. Whereas in stock dividend or bonus, it will not be split. Okay.
Yeah.
Then share repurchase. Reverse stock split means clubbing together. So multiple, let's say 10 stocks is clubbed into one stock here. 10 stocks is clubbed into one stock. Okay, 10 stock is clubbed into one stock. That is reverse stock split. Okay. Then 10 stock is clubbed into one stock. That is reverse stock split. Just 1 minute. So here, reverse stock split means what? Multiple stocks will be clubbed. So 1 rupee, each stock valued 1 rupee, 10 stocks are there. It will be clubbed into one and it will become 10 rupees. Okay, that is reverse stock split. So earlier the face value was 1 rupee. Now the face value will become 10 rupees. So it is opposite of stock split. Okay, so why this will happen or why stock split will happen? Stock split will bring in more liquidity in the market. So now earlier what was available at 1000 is it is available at 100 now. And reverse stock split will happen so that when the price is too low, it should not happen that another coronavirus, all that thing happens and the price comes down to zero. That should not happen. So they will try to club shares together so that the price goes up. Okay. Then share repurchase means buyback of shares. So a company can buy back shares as well. So that time it is called shares repurchase. So when they buy back, then the number of shares in the market will be reduced. And so earning per share will go up. Okay. Then this is dividend payment chronology. So these are the dates which are essential. So for example, dividend payment chronology, first is declaration date. So if they are declaring today, so today is what, 15th December. So 15th December is considered as the declaration date. But they are declaring what? They are declaring that they will pay dividend. So when? So let's say 10th of January. So 10th January is called as the pay date. Pay date. Now payable to whom? Okay, there are so many owners and ownership keeps on changing. So they may say they will pay on 5th Jan. 5th Jan will be considered as the record. I mean, they will pay to those people whose names are there on the record on 5th Jan. So this is the record date. Whoever's names are there on 5th Jan, dividend will be paid to them. Now the question is, whose name will be there? So only those people's names will be there who are trading on or before a specific date. Okay, who are trading before a specific date. Let's say before a specific date. So what does that mean? Because it will take T+2 working days to get settled. okay, for a trade to get settled. So if you trade on 5th, it is not enough, because this will be t plus 1 will be 6th, t plus 2 will be 7th. So it is getting settled on 7th, and that is too late for the buyer. So the buyer should enter into the trade. Let's say if he is entering into the trade on 4th, then t plus 1 is 5, t plus 2 is 6. Okay. And then if he is entering into, so there's the 6 is also late, because 5th he should be the owner. So if he is entering into the trade on the 3rd, so that is t plus 1 is 4th, t plus 2 is 5th. So now he is becoming the owner. So 3rd or before 3rd, any date is fine. 4th onwards, it is not acceptable. So this 4th Jan is considered as X date or X dividend date. That means the date on or after which, if the buyer is buying, this is the date on or after which, if the date on or after which, if the buyer buys the stock, he will not be eligible for dividend. He will not be eligible for dividend. Okay, he will not be eligible for dividend. Okay, so that means 4th or after 4th is not eligible for dividend. Any date before 4th is eligible for dividend. So if he buys on 4th, then who will get the dividend? Seller will get the dividend. Okay. 5th, if he buys, seller will get the dividend. 3rd, if he buys, the buyer will get the dividend. And this dividend, this X date is provided by the stock exchange. That is very important one. This is provided by the stock exchange. Rest of the dates are provided by the company. Okay. Okay, so now here comes the sum. So here, just go through the question. You want me to explain this sum?
No, sir, it's fine.
Okay, I'll do this sum. Just go through the question.
Done, sir.
Okay. So multiple period dividend discount model valuation. So recently paid 1.5, expected to grow at 8% per year. 1.50 and expected to grow at 8%. So 1 plus 8%. Just calculate this.
And 0.62.
8% per year, then, and also it will be priced at 51 3 years from now. Oh, this is, then every year it is growing, right? 8% per year. So 1, 2, 3. Then again, you just increase it by 8%.
1.74. 1.87.
And after 3 years, it will be sold for 51. So that means this is 52.87. So these are the cash flows. Now, if these are the cash flows, based on this, what is the price over here? So you think all like, future cash flows. So we just have to discount it, 12 percentage. So this one divided by 1 plus 12 percentage raised to 3 years away, and store it. 1 plus 12 percentage raised to 2, and 1 plus 12 percentage raised to 1.
35.82. The total.
35.82, then it is not matching. Yeah. This is 1.75. Okay, and this is 1.89. 35.82 you said, right? Oh, no, it is not
Yes.
matching.
So we've done 51 divided by 52.87 and then discounted it, right? They've directly done 51 divided by
No,
12%.
that is fine. That all those doesn't matter, because you take separately and again twice you divide, or you divide once together taking all number. It should come to the same only. One is they have given this number as 1.75 and this one is 1.89, but still it's a big gap. Okay, what is the so you are not getting 40.49. What are you getting?
35.82. I'll just try once again. I'm getting 39.14. I'm not getting.
That is okay. 39.14. This is 40.49. No, that is because this number you have taken it differently, right? That is the reason. So it is fine only.
Okay.
Then We don't have any sums here. This sum will come in CFA, FSA only. Okay, free cash flow to equities. This one is a part of FSA. Should I explain this?
Yes, sir.
Okay, so I'll just quickly tell you the format. See, first of all, free cash flow to the firm. So there are 4 ways here. Net income plus interest. Just 1 minute. Interest into 1 minus tax, then plus depreciation minus working capital investments minus fixed capital investments will give you free cash flow to the firm. Okay. This is non-cash. So we are adding, which we have already deducted in the income statement. Then this is interest. This is cash only, but it is interest because now firm means both equity plus bondholders. So we are not separating them, and that is why I'm going to add this interest that has been paid. I'm adding back. I'm thinking that all are same only, as if like I have not taken any loan that way. Okay, this is fine. This is okay.
Yes.
Then next one is EBIT perspective. So EBIT perspective directly. So I'll write here the format. Sales minus cost of goods sold, gross profits, sales general administration, EBITDA minus depreciation, okay. So now from net income, when you start the story, this is and this one are the problem which we have addressed in this one. Now from EBIT itself, we are directly paying tax, so there is no problem of interest. So now depreciation has been deducted, so I will add back depreciation, and then these are all future expected expenses, working capital investments and fixed capital investments. EBIT into, this is one minus tax. EBITDA into 1 minus tax. Okay. EBITDA into 1 minus tax. So from EBITDA, when I'm paying tax directly, so I tend to overpay tax there. Ideally, it should be no depreciation problem, no interest problem, because I'm directly paying tax. So no rectification. So I can directly write minus working capital investments minus fixed capital investments. But however, this is wrong. Why? Because I have overpaid tax, because I was getting some tax reductions because of the expenses. These expenses will reduce my EBIT. So my tax also will come down. But right now I'm not getting that support because I'm directly paying tax based on EBIT. So I'm overpaying tax. How much am I overpaying tax? That is equal to depreciation into tax. tax rate that I will add back. Okay, depreciation into tax rate. So this is another way, free cash flow to the firm. Then another way is CFO. So CFO perspective, interest rate is already deducted in CFO, so I will add back because I don't want to separate it. So interest into 1 minus tax, and then minus fixed capital investments. Free cash flow to the firm. These are the 4 ways. Then free cash flow to equity. Okay. Free cash flow to equity. Now here FCFF and CFO. FCFF minus interest. Now I'm separating this interest. Then plus or minus net borrowing. If more borrowing we have done, it will be plus. If we have repaid the borrowing, it will be minus. Okay, then CFO is CFO, and then minus fixed capital investments, then plus or minus net borrowing. Okay, is it fine till here?
Yes.
You can add one more also, like from FCFE, if you pay dividend and then plus issuance of equity. Issuance of equity means more cash is coming in, or repurchase minus repurchase of equity. So this will give you net change in cash. Net change in cash. Okay. Fine, okay. Then preferred stock valuation. So preferred stock valuation is, preferred means here perpetual. So for perpetual, it is annual payment, annual dividend payment. So I'm simply writing payment divided by discount rate or required return. So annual payment is how much? 5 divided by required return is 8%. Just calculate this.
$62.5.
So this is the present value of the preferred stock. Okay. Then Gordon growth model should be used when you expect constant growth. And you should know these 3 assumptions also. They may test theoretically possible. Okay, easy one only, based on the formula only. So because you can use Gordon growth only if they are paying dividends. Okay, consistently if they are paying dividend, and dividend is growing at a constant rate. Okay, So here, so the formula is what? So formula will be, it is like this: required return is equal to dividend yield. I'm just deriving now. Dividend yield plus growth. So dividend yield is D1 by P0 plus G. So based on this, I can say R minus G is equal to D1 by P0. So now P0 is equal to D1 by R minus G. This is Gordon growth model formula. Okay. Now you just have to plug in. You can try this quickly.
Done, sir.
Now out of this is the continuation. Out of how much? Out of this amount, what was the amount? The amount was 40.4, 40.50. So 40.50, how much is because of dividend growth? So if 40.50, so you have to do like this: no growth and then with growth. So if it is no growth, then how will it work? So if there is no growth, so if there is no growth, initial dividend was what? Initial dividend was 1.50, no? If there is no growth, so this format only, the way we did before. No growth means annual payment. Okay, same way they paid 1.50 and then it was not growing, divided by required return 12%. Just calculate this.
12.5.
So it should be 12.5 with no growth, but however now it is 40.5. So the difference is with growth, because of growth. How much is that coming to? I think 28 rupees, right? 28 is because of 28, 30, 40, 40.5. Yeah, 28 is because of growth. 28. Then sustainable growth rate. Sustainable growth rate is, growth is equal to, this is how I remember, R into R. R means, then I write return on equity into retention ratio. This formula you have to remember. Remember means if you understand the logic, it becomes easier. Okay, return on equity is equal to net income by average equity. And then retention ratio is equal to retention ratio is equal to 1 minus dividend payout ratio. Dividend payout ratio is equal to 1 minus, no, DPS by EPS, dividend payout ratio by earning payout ratio. Okay. Dividend per share by earning per share. These are the formulas. Based on this, you can get the growth rate. Here it is directly given. Dividend paid is 25% and return on equity is 21. So if dividend paid is 25%, retention is 75%. So retention is 75% and return on equity is 21%. So multiplied these two, 21% into 75%. 21. Just calculate 21% into 75%.
0.15. So
Yeah.
15%.
Ah. 15.75 are you getting?
Yes.
Okay. Then a firm with no current dividend. A firm with no current dividend. Just go through this question now. A firm pays no current dividend but is expected to pay at the end of year 4. So this is 1, 2, 3, 4. Year 4 earnings are expected to be 1.64. This is earnings, not dividend. And the firm will maintain a dividend payout ratio of 50%. So dividend will be equal to what? 0.82, correct? 50%. Assuming a constant growth rate of 5% and a required rate of return. So constant growth means what? I can use Gordon growth model. Okay. So from here on, I can use Gordon growth model. So divided by, so this is expected. If I think of this as the expected dividend, okay, divided by 1 plus required return is 10%. So it will push 1 year back, P0. Just calculate this value, 0.82 divided by 1 plus 10%.
0.745.
0.755 divided by 1 plus 10%. This is for 3 years. That's it. There is no other cash flow in between, so nothing will come.
Point 559.
0.559. It's not matching. 12.32. Acha, because I have not done. See, this is Gordon growth, no? So I have not done this properly. Incorrect. R minus G I am supposed to take in the formula, right? R is 12%, 12 or 10%. Minus growth is what? Growth is 5%. Now you calculate. 0.82, this is dividend. 0.82 divided by 10% minus 5% will be 5%. So 0.82 divided by 0.05.
1.64.
1.64 divided by 1 plus 10% raised to 3. But still, $1.64 or 16.4. Just check again. 0.82 divided by, see, 10% minus 5%. How should you?
16.40. Sorry.
Yes, yeah, 16.40. And that you discount it now.
$12.32.
Okay, here. Then multi-stage growth. Okay. So stock dividends are expected to grow at 15% per year for 2 years, after which expected to grow at 5% indefinitely. 15% per year for 2 years. Okay. So right now dividend paid is $1, growing at 15%. So that will be 1.15 into again 15%. Just calculate this.
Sorry, sir, what do I have to?
Just calculate this number. 1.15 into 1 plus 15%. It is growing at 15%.
Okay.
Right. For 2 years.
$1.3225.
And then it is growing at constant rate indefinitely at the rate of 5%. The moment they say constant, I can use Gordon Rule. So divided by R minus G. R is this one, cost of equity 11%, minus growth is 5%. So just calculate this part.
$22.04.
So it will push 1 year back 22.04. So now you can add these two amount.
23.19.
So divided by 1 plus discounting for 1 year. This is discount.
$20.89.
86. That is fine. A decimal thing. Okay. Are you able to understand all this?
Yes, sir. Yeah.
Okay. Then relative valuation. Relative means what? Relative means, my neighbor's home is for 50 lakhs, so my home should also be 50 lakhs that way. So here price to earning multiple, price to sales, price to book ratio, price to cash flow. These ratios are used. Okay. And also, yeah, a couple of other formulas also. Price to earning. What is the formula for price to earning? So that formula is important. So price to earning is trailing price to earning ratio. Trailing price to earning ratio, which is also called trailing price to earning ratio. Then another one is leading price to earning. So because it is leading, I'll write E1. Okay. Leading price to earning ratio. This is leading is also called forward. Okay. Then forward P ratio. Okay. This trailing P, or I can say historical P ratio. So here how the formula goes is using Gordon growth model. It goes like this. First you take only price. So what is the formula for price according to Gordon growth? D1 by R minus G. Then you divide by E0 both the sides. E0, E0. Now it becomes price to earning trailing because I'm using E0. Now further I can write this as D0 into 1 plus G divided by E0 whole upon R minus G. So now this becomes dividend per share D0 by E0 into 1 plus growth divided by R minus G. Okay. So now further dividend per share is 1 minus retention ratio. Retention ratio into 1 plus G by R minus G. That is equal to, this retention ratio is denoted as B. 1 minus B into 1 plus G divided by R minus G. This is the formula. Same thing. Now, if I write from leading PE perspective, D1 by R minus G, so divided by E1 divided by E1. So that becomes D1 by E1 is dividend per share divided by R minus G. So dividend per share is 1 minus retention ratio by R minus G. That is equal to 1 minus B divided by R minus G. Okay, so this is the formula. You may get one question based on this. Anything may be asked. So you should know all these steps. And all are logical only. There is nothing to memorize here. Just you have to understand and practice it. Okay.
Okay.
Rest is all direct only here. It's just one step only. You can go through this question quickly.
Done, sir. Yeah.
These all are theory one. This all, if you understand the concepts when you read, you will be able to understand all this. This is again, you should be able to price to earning lagging, lagging. So this is also called lagging P ratio, lagging historical or trailing P ratio. Okay. So lagging P ratio, this only they have applied here, price to earning lagging P ratio for 2003. So here is the price. Earning per share we want. E stands for earning per share. So here how they have done is, see, this is stock price. See, except stock price, all figures are in millions except stock price. So stock price is what? For one share. So I want stock prices, prices, price to earning. So I know price is 11. Earning is earning per share. So earning per share, how will I find out here? So earning is given total net income. This is million, 3.2 million. Okay, earning per share, 3.2 divided by number of shares, 4.476. Just calculate this. So this is net income by total number of shares. How much?
0.714.
And calculate this.
That's 11, right? 11.
Yeah, price is 11 here. It is 11.4, sorry.
15.96.
So that is price to earning ratio. Same way we have to do for rest. 15.9, 15.96, 15.9. Okay. That you try later on. If you face problem, then you let me know. But same way only. So everywhere you have to calculate price. Numerator is given. Denominator you have to do it in this way. Similar to this way. Then enterprise value. Enterprise value is when you are acquiring a company. So EV multiple, similar to price multiple. Price multiple is when we are buying shares of a company, like when you are buying few number of shares, minority shareholder. But when you want to acquire, you are interested in the entire enterprise value divided by EBITDA. So EV is equal to what? EV is equal to market value of equities plus market value of bond plus, not bond, I should say debt, because all debt it includes. Okay. But many times if market value is not available, we will use book value. Okay. Then plus market value of preferred stock minus cash and cash equivalent. That is the formula. Cash and cash equivalent. So now coming to this sum. Okay. So EBITDA is, just go through this question now.
Done, sir.
So market value of equity is what? So EBITDA is directly given 1 million. Now EV. Market value of equity will be 40 into 200. No, 200,000. That much. Then market debt. See debt. See here they have given long-term debts market value, but short-term debts market value is not given. So, but overall book value of total debt is 2.1 million. 2.1 million. So this is book value of total debt. So out of this, book value of long-term debt is 900,000. Book value of long-term debt is 900,000. So what should be the book value of short-term debt? The remaining amount, how much is it remaining?
What is the long term, sir?
Long term is 900,000 right here.
Yeah, okay.
Book value of long-term debt is 900. Total debt is 2.1 million. So remaining should be short-term debt.
1.2 million.
1.2 million. So now, but we want market value. So they said long-term market value of long-term debt is 600,000. So I don't want this 900. I will take 600,000. Okay, but now I don't have the long-term, market value of short-term debt. So I will take the book value. So I will add these two. So that comes to what? 1.8 million, right? 600,000. Yeah, 1.8 million.
Yeah.
So this amount plus 1.8 million. Preferred stock is nothing, not given only. Cash and cash equivalent is minus 250,000. You understood this one? This number, calculate all this. This is cash and cash equivalent, you should reduce. You're calculating, right?
Yeah. It's coming to 95 million.
95 million.
Yeah,
9550.
yeah,
9550. So 9550 000 divided by 1 million. So that will give you 9.6 approximately.
Yes, 9.55.
Okay. Then asset-based model. Asset-based is just net asset value we have to take, taking the market value of the assets and liabilities. So just go through this one now, the last sum.
Done, sir.
Read the question.
Yes, sir.
So here there is only one change. They said asset-based model, right? So asset-based model means net assets divided by total number of shares. Number of shares are given 2000. So net assets based on the fair market value. Okay. The analyst estimates that the market value of net fixed assets is 120%. Okay. So here cash net fixed asset means this one. Only this is the change. Cash 10,000. Then accounts receivable 20,000. Inventories 50,000. Net fixed assets, they said 1,20,000, but it is the market value is 120% of book value. That means if it is 100, it will be 120. So if it is 120,000, how much will it be? So cross multiply.
One lakh 44,000.
So all these are assets. Now you add up all this.
Two lakh 24,000.
Accounts payable is 5,000. Notes payable 30,000. Term loans 45,000. So this equity will not come. This comes to how much? 75, 80,000. So take the net.
One lakh 44,000.
So 1,44,000 is the net value divided by number of shares, 2,000. So 72 per share. Okay. Fine, understood this one?
Yes.
Okay, I think that's it here. Yeah. Okay, we'll stop now here.
Okay, sir.